Good day, guys. Welcome to the DMS FX. So on this channel, as usual, I am going to be teaching you what Forex trading is. All right. So remember in our previous video, we looked at, I've actually put an alarm on my trade here. Let me see what is going on. Okay, so this alarm has just gone on. Let me see if my entry model, okay, it's going to be, I want to place a trade on BTC USD. So I just had to put an alarm here, and an alarm has actually gone out. So I am going to wait for my entry model. So let me just put this one here. Okay, so this one might help me to, now because I'm interested in the buy, so I'm trying to see the entry model, which I'm going to see if it will be created, then I'll be able to enter in the trade. Okay, so this alarm again has gone. So let me see if it made my entry model maybe in the 1 minute. Okay, so in the 1 minute, my entry model was met. So in terms of entry, I'm supposed to enter like that. I'll enter like that, then go for a 1 to 2 risk to reward ratio like that. Okay, let me see how I'm going to make it. 1 to 2, okay, just here. Okay, so this is a 1 to 2 risk to reward ratio as one of my entry models. So this is a trade that I'm in. So let me see if it is going to not violate my on the other time frame. Okay, we tapped in this fair value. Now we are pushing up. Okay, so yeah, we are pushing up as expected. Yeah, so it's a 1 to 2 risk to reward ratio. So I just made the entry. Now when I make the entry, I use what I call set and forget. So set and forget, meaning that I'm not going to tamper with this. And then the TP, I'm going to set the take profit here. So this is the take profit here. I'll set it as the TP, take profit. Then my psychology, I'm going to tell my psychology that anything from here up to here, okay, that's how I organize my psychology so that I don't tamper with the trade. So anything I've entered, any price action from there, I'll say that is not my money. I've done that to help me with this psychology, because whenever price begin coming this side, I'll start thinking of changing. So anything within this position is not my money. So again, I'll say, where is my money now? So I've set and forget. I will not tamper with this trade. If it decides to hit my stop loss here, then that is it. Okay, then what I'm going to do is to indicate where my money is. So I'll say my money is here. This is what will help me with my trading psychology. So I'll indicate where my money is. Okay, meaning after TP, that's where my money is. Okay, so my money is here. So I'm going to show the arrow here. When price reaches here, then I know that I have the money. But before price reaches here, I do not have the money. No. So any money that is I'm making from this movement up to there, it's not mine. Until price reaches here, that's where I'll say that's my money. Okay, so now this is what I've done. I'll come back to it. Let me go back to where I was. Actually, I was under here. So I was trying to talk about what Forex trading is. Remember, we started this lesson um, in the previous video. We started this lesson in the previous video where we talked about Forex trading as foreign exchange, where I said the word, actually here, I was supposed to say the word Forex means actually foreign exchange. So retail traders are, as retail traders, you and me as individuals, we get involved in forex trading in the name what we call CFDs, which is contract for difference, meaning that we sign a contract between you as a trader and also a broker that each one of you must pay each other for the difference in price uh, between the entry point and the exit point. Okay, and then I explained to say forex trading is more like betting. Why did I say more like betting? Because I said in forex trading, what we do actually, we bet for price increasing or for price decreasing. Okay, that's what we do. And then we said the kind of betting which we do in forex trading is not the betting that is done in football, but it's quite similar. All right. So the kind of betting that we do in order to know whether price is going to increase or decrease is based on what we call technical analysis. And that technical analysis is based on price action. Okay. So when you look at what we have here, we have what we call the chart. Let me just delete everything on this chart so that we begin properly. So what we have is what we call the chart with what we call candlesticks. So these candlesticks here, they represent what is happening in the real world. Okay, so the candlestick are showing price movement in the real world. Okay, so like these red candlesticks here, they show decrease in price movement in the real world, and then these green candlestick which are going upward, they show price increase in the real world. Okay, so you and I, when we get involved in forex trading, we have to bet whether to bet for price going up or for price going down. So if we betted that price is going to go up and it went up, we are going to win. If we betted that price should go up and then price went down, then we are going to lose. Okay, so that's what forex trading is all about in a retail sense. So now, the betting that we do, it is based on history to analyze what the market has been doing. Okay, so for instance, I told you that market moves in three ways. We have three models of the market. I talked about the bullish market, which goes upward like that. Okay, this is a bullish market. That's how it goes. It goes upward like that. Then we have another one, which I said the bearish market. So the bearish market moves in downwards like that. Okay, so it moves like that. So this is how a bearish market moves. So sorry, it's like my computer is actually freezing for some unknown reasons. I don't know whether it is very hot on what. So yeah, so it has responded. Then we'll go like this, like that. I don't know what the issue is, whether it is the internet or the computer itself. Let me check if it is the computer itself. I will check with the internet on my phone because it's connected to my phone, so that I'll be able to see whether it is actually the internet which is contributing. Yeah, it appears that the internet as well is affecting the, because I can't seem to connect. Yeah, I've seen that everything has disappeared there, so it is to do with the internet as well. So I think it is to do with the internet. Let me check again. Okay, so we are back. Okay, so the internet seems to have improved. Yeah, so this is how a bearish market moves. Okay, so a bearish market moves downwards in steps. Then we have another model in which the market moves like the sideways or the consolidation. Okay, like this. Okay, so these are the ones that we use to make our decision whether we buy or sell the market. Okay, so for instance, if I were to ask you on this price movement that we have right now, which model of market structure is being represented here between the first one and the second one and the third one? So you tell me that it is the first model of market structure. So here we have the first model of the market structure, where we have seen that the market moved up like that, then came the lowest point here was this, then moved up, the lowest point again was that, then it moved up there, then it made the lowest point there, then it moved up. Now, what are we expecting? It is moving down. So we expect it to move down like that. Based on what we have seen, when it moves, again, we expect it to go up, right? Because that's what it has been doing. So now that we know how the market has been doing, if you came into the chart and found the market is where it is now, here, it is here. So it is very logical for you to do what? To sell, to predict that now where it is, the market is going to go down, because it has already given you the first candle here, red, which signals that it is going to move down. However, we do not know how far it is going to go, whether it will come and reach at this point here. We do not know whether it will reach here, or it will just make a small movement up to the middle there. We do not know. However, what we know now is that it is going to make a move from this point to somewhere, or it has already made a move. If this move is enough, we can also predict that it is going to go up there. Okay, so now this is how we make these predictions. So these predictions are based on analyzing the market. So like this bullish market, in this bullish market, these regions here, like this upper region here, are called higher highs. Okay, so you need to understand the terms that are used. So those regions are called higher highs. Okay, so those are called higher highs. So these are higher highs. Let me just increase the size so that you see them properly. So it's a higher high, this one. Okay, then after having a higher high, we are supposed to have a, sorry, let me just copy this one. This one is called a higher low. So this one is called a higher low. Then this next one, again, it is called a higher high. This one, a higher high. Then this one again, the next one, it is called a higher low. Then the next one again here is called the higher high here. So like where the market is now, it has formed a higher high. So it has been, this was a higher low, a higher high, higher low, higher high, higher low, higher high, higher low, higher high. Okay, so now when the market is moving downward, now it makes what we call higher high, higher, we form higher low, lower high, lower lows. So this one will form what we call, it will start from here. We'll mention this one as lower. This one is a lower high. So the market will be making those. So this one is a lower high. Then this step, okay, it will be called a lower low. Lower low. Okay. It's very important that you understand these simple terminologies, because when you come into the market, once you understand these, you will be able to organize yourself psychologically to flow with the market. You organize yourself psychologically to flow with the market. So it is making lower high, lower low, lower high, lower low, lower high, lower low. Okay. So now these, like higher high, these are called resistance. These are called the resistance. This one is also a resistance. This one is also called a resistance. Then these are higher low. Here they are called the support. So this one is a support. This one is a support. Then also here, when you come here, again, let me just organize them nicely a bit oddly, because that time I was making them, the internet and the computer was almost like freezing. So let me just organize them properly so that we can see what to do. So let's see where we are in terms of that trade which I made on BTC USD. I just want to see where we are now, if we are making progress or not. Okay, we are actually there. That's where we are. So we can leave the trade running like that. So we can leave it running like that. It is a 2-to-1 risky reward ratio, or 1-to-2 risky reward ratio. Set and forget. I am not going to tamper with it. If it comes back, hits the stop loss, then that is what it is. Okay, I have no control on it. If it goes, it hits the TP, then that is it. Would have made something there. All right, so now getting back to what we were talking about here. Yeah, so now it's very important to know. So here it is making high high, a lower high, lower low, lower high, lower lows, like that. Okay, so now this is a lower high. I needed a lower low here. Not this one. I'm actually getting this one. Okay, this one here. So this one doesn't have a consolidation market, doesn't have the lower low, lower high. It just have the, this one is known as the support level, the bottom one, then the highest it has reached here where the price reaches and then bounces back. This one is known as the resistance. So if you are doing forex trading, guys, as I said, you are just doing what? You are just betting. Okay? You are not sure of what the market is going to do. You are just betting. So, but you are betting based on previous history. Okay? Like here, when you look at here, the market was doing lower high, lower low. So this one is a lower high. So it was high high, then it made lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low. Then it changed. It made higher high, higher low, higher high, higher low, higher high, there, higher low, higher high, higher low. Then it changed again. So the market changes. But here it almost moved like the same levels here. The levels, they were almost the same. So if I remove this one here, you see how it will look. So here almost the market was consolidating. Here the market was in the bearish direction. Here it was in the bullish direction. Now, when you are in a certain trade, it is when you are on a chart trying to analyze to understand where the market is going to go, like we are here, it is upon us to identify the structure. Let me just get rid of this first. Okay, so now it is upon you to identify the structure. So you have identified the structure and you have realized that it is forming higher high, higher lows. Okay, so if the market is forming higher high and higher lows, for instance, okay, I can't form a replay. Let me see if I can do a replay on a daily time frame. Okay, on a daily time frame I can form a replay, I think. So here price was higher high, higher low, higher high, higher low. Here it was doing like higher high, higher low, higher high, higher low, higher high, higher low, just like that. That's what price was doing. So I'm going to use a replay button where I'm going to say, okay, let's say I found it here. This is where I found the market. So I want to know what it is going to do next here. What will price do next going forward? So I will try to see, okay, it went high, it went low. Then it might go up again. So see, I'll just play one candle just like that. You have seen it has gone because I saw that it went up. So now I will place again another candle. You see, there I'll wait. I've seen that, oh, it has made a red. It has come down. So once it comes down, what am I expecting? To go up again. Okay, so see, it has gone up. So when it is here, you have to place a buy because you know that from here it is going to go up again. Okay, so you place a buy. So if you place a buy and it doesn't go, it will stop you out, you lose. Okay, but definitely it will go up. You have seen it has gone up there again. Okay, so you continue. You have seen. So here I've just replayed back in history just to show you what happens and how the prediction is done. Like here it has gone down. So as it has gone down, you expect it to go up, and it went up. So during that period it went down. You know that the market is doing, it goes up, down, up, down. So whenever I see it down, maybe it will go up. Okay, if you see it go up, it goes down. Like here it is up. So what are you expecting? You may expect it to go down. So there it has moved down there. You have seen the red one is for down. So it has moved down again there. So when it goes down again, you expect it to go up. So here it continues going down, down, down. Okay, so it was just going down. Then it started going up. So here again it went down. So it continued just going down. Then there it changed up, up. So now here it will be now going up, down, up. So there it has gone. So now it is to have what we call now technical analysis, because I am on what we call a daily time frame here. So these are what we call time frame. We have monthly, weekly, daily, 4 hour time frame, 2 hour time frame, 1 hour time frame, 30 minutes time frame, 15, then 5 and 1. These are the time frame which I use. Now, if you are to predict well when the market is going to go up, you wait for what we call break of structure. Let's say the market has been going like this, okay? Then it comes like this. So for you to know whether it is going to go up, you wait the market to come and break this one. These are called structures. So this one, when the market crosses this resistance, so we call it break of structure. So it has broken the structure here. Okay, let me just remove this part here and just put this one here. Okay, let me see if I have something there. No, so I can just do like this. Okay, break of structure. Okay, okay, oh sorry. Okay, so this one is a break of structure. So the moment the price breaks the structure, if a price is coming, it went down, it comes here, it breaks the structure, then what am I going to do if I want to buy? The moment it breaks, it will form like a small candle like this. A small candle closes there. Once that small candle closes there, you enter for a buy. You put a stop loss somewhere, then below the previous low, you put a stop loss, then you target maybe a 1 to 3 risk to reward ratio. Here, a number reads here 1, here it's 2.5. It means that if I'm risking $1, I'm making $2. Okay, if I put, maybe I'm saying I'm betting for the price to go up, so it should go up 3 times. Okay, so meaning if I've put there $3 will be multiplied 3 times and I'll make $3. But where I put the stop loss, a stop loss is a risk management which is put in place to stop you out of the market if the trade goes in the opposite direction. Like here, where I placed a trade on this one here. Let me just go on. We were on what? 5. Okay, so let's close. Let's just stop this one here. Let's close so that we go back to what we were doing. I want to show you how I did this. Like we are in this trade where I said set and forget. So in this trade where we are, which we said set and forget, we entered here. If the market comes and hits this level here, it means I've lost. And if I had to put there like $5, it means I've lost $5. But if the market reaches this point here, if I had to put there $5 will be multiplied by 2. It will be $10. So I'm going to make it $10. Okay? So that is what we do in Forex trading. So you put a stop loss to prevent you from losing a lot of money. Let's say in your trading account you have put there $50. And if let's say you are wrong in your prediction to say the market will go up, then yet the market goes down. If you don't put a stop loss and the market continues going down, all your money in your account is going to be lost. Okay, so your money will be continuously being lost bit by bit until everything is lost there. So that's why you put a stop loss to say if I'm wrong in my prediction that the market is going to go up, this is where I expect to be stopped. So stop me out of the market at this point there, then the market will stop you from here. Like it is coming down. If the market comes here and hits here, it goes down. I'm going to lose a $5, meaning that my direction was not respected. And I'll move on. I'll accept because that's what it is. Because in Forex, I'm just predicting to say if the market, because I saw a very strong bullish candle here, so I was suspecting that the market is going up because there is a strong buying power. Like the institution now have joined the market. Big institutions have joined the market and they're pushing the market upwards. And because of that, I'm betting that it will continue going upwards because of this strong buying pressure which has entered the market. That is the one that has made me enter the market in that way. Okay, now if the market is not going to continue and it goes back, then it should stop me here. Of course, it can go back due to the fact that there are other factors. There are other people that might start selling. Okay, the the going of the price up like this, it's an opportunity for others also to sell, especially for others that had maybe entered here the market. They entered the market here, so they have made a lot of profit up to here. They can exit the market. And if they're big institution, when they exit the market, then the price is going to go down. So for me thinking that the price is going to continue, the probability of me losing is there because this bullish movement like this, buying movement like this, can also make others exit because they would have made profit in this movement already and they can exit. And if they're exiting with a lot of money, they're removing a lot of money, it means price is going to drop. So it doesn't mean that my prediction that the price will go up was wrong. No, I wasn't wrong. It can actually go, but the same, this pressure which has gone up can also cause others to come out because they have already made the profit by this movement here. Imagine others entered here and then there was this movement which went up here. It means that they made profit and they will exit the market. As they exit, if they're exiting with huge amount of money, that huge amount of money will cause price to go down and therefore I can end up losing. But if they don't exit, some joined continuously buying, then the price can continue going and hit my take profit here. Okay, so going back to what we were analyzing here, what we were dealing with here, we are saying when the market reaches like here, in your analysis, when the market reaches, for instance, here, and a candle closes, let me just go lower in time frame so that we see what was going on. So you see, this is the level here. So you see that a candle has broken this level and has closed somewhere here. It is an opportunity for you to enter the market to say, oh, now there is buying pressure. Like I've told you there is buying pressure which has come in the market. So the probability that the market now wants to make another movement here, after it broke this part, it made this movement. Again, after it has broken this part, you're expecting it again to make another movement. And therefore, you enter for a buy here. Okay, you enter for a buy, then you put a stop loss somewhere near the lowest level here. Okay, then you target either a 1 to 2 risk to reward ratio like that. I'm looking for a 2 somewhere here. Okay, here is a 2 here. So I'm saying when the price reaches here, if I had to put $10, I will make $20. From here, I entered with a $10. When it exits here, I am going to make it $20. But if I am wrong, then that $10 is the money that I'm risking. So if it comes in reverse, instead of going up, it reverses and it continues going downwards, then I'm going to lose that very money there. But if my account has got let's say $40 or $50, I'll lose let's say $10, remain with $40. Okay, but if I had not put the stop loss there, it means that I'll continue losing as long as the market goes in my opposite direction continuously. I will continue losing. Okay, so that is how actually uh, forex trading is. So as retailers, we just bet whether price is going to go up or price is going to go down. So if we bet that price is going to go up, we buy. If we bet that price is going to go down, what do? We sell. That's what we do. So let me go somewhere where we saw price selling nicely. I want to go where we saw price was selling nicely. Okay, let me go to 4-hour time frame so that I can be able to reach that part where we saw even here price was selling, then it reversed. So here someone could have lost here. Someone could have lost here. Why am I saying someone could have lost here? You see, when the price started going up, it started going downward here. So someone thought, oh, again it has broken this level, so it will continue going downward. So let's say they entered a sell here. When this candle closed, they entered and they say, oh, the lowest structure is this one here. And then I'm targeting a 1-to-2 risk to reward ratio. So a 1-to-2 is somewhere here. So meaning that price did not reach their level. If they say 1-to-2, price should reach that level. So price started coming, almost reached there, and reversed, started going this way. Now, if they never put a stop loss here, they were going to lose all the money in their account. Okay, but because if someone put a stop loss here to say, if price reverses in the wrong direction, which I've not predicted, then let me be stopped out of the market. So they'll be stopped out of the market. Okay, so they will understand. So now this is why trading can be good, because in trading you can prevent losing. Now, for you to prevent losing in trading, you need to have proper psychology and also proper risky management. So proper psychology is where you follow your rules. Like here, I am following my rules. How am I following my rules? I am saying I am not going to tamper with the chart. I'll leave it. I'll leave it. As long as I've analyzed very well, I've done the analysis. If I've done the analysis well, like I've done, I will not tamper with the chart. I'll let it go, either hit stop loss or hit take profit. That is it. There's nothing that I'm going to do about it. I'm just going to leave it like that. You don't tamper with your initial conditions. Once you analyze the market very well, then leave it like that. What will make you get profit or be profitable in the long run is the risk to reward ratio that you are going to have. Okay, so now this video I'm going to stop here to avoid it being long, but in the next video I will even be clear in everything that I'm going to explain should I have proper network, because today what is disturbing me is the fact that when I started the video, the alarm that I had set on my BTC here went went on, and therefore I had actually to come and place a trade there. Okay, so that also disturbed me. Okay, so there were two alarms that went. The one that I was waiting for the price to tap the fair value gap. After price tapped the fair value gap, price also uh, broke the structure there. So I also left an alert here, somewhere here, where I entered from, where I said, should the price break the structure somewhere here, then I'm going to enter the market. So price did actually the same, broke also the break of structure there, and that's how I entered the market, and price started moving in my direction as it is moving. So that affected me to teach the video the way I had planned to teach, because it's like I've done two things in my video. So now what I'm going to do in the next video, I will be able to explain bit by bit how the market moves, and how you can enter and how you can exit. So remember to subscribe, like, comment, and share. In the next video, I am going to show you whether this trade, should I close this video without this trade hitting here, I will show you that the trade did not hit. If it had to hit this one, I will show you. Okay, it appears like, even as I'm recording now, it's like we're already hitting that point there. But if it will not hit, I'll show you in the next video, because the probability is high that it cannot hit. You have seen it almost reached there and then it pulled back. So the probability is there that it cannot hit. It can just reach closer there and then reverse back to here. So in the next video, I'll show you whether it hit or not. Therefore, subscribe, turn on the notification, so that when a new video is uploaded, you'll be able to be notified. And also remember to like, share, and comment in the comment section. It is going to help the YouTube algorithm to push this video to as many people as possible. Okay, so this channel is going to offer the best knowledge that you can find on YouTube. Okay, so that you will be able to also use it and also become profitable. Other than that, also I'm also going to do a prop firm challenge, where which is going to begin in November. So I've actually gotten a prop firm challenge with the funded next. Okay, which you need also to watch on this channel. I'm going to show you how I'm going to start, whether I'm going to win that challenge or not. You will be able to find those videos here. Therefore, you need to subscribe to be able to track the record. At the moment, guys, I'm quite still a poor guy. I'm beginning, so let's begin the journey together. If we can make it in Forex, then we can make it, all of us. So for now, bye, and see you in the next video. Peace.